Welcome back to Investing Talk Podcast.
Today we are taking a look at Riot Platforms. And this is a really crucial one right now because, they're actively trying to shed that image of being just a pure Bitcoin miner.
Right.
They're in the middle of this massive strategic pivot toward high-performance computing, or HPC, and AI data centers.
It's a fascinating mix of industries, and we are definitely going to dig into what that means for investors. But first, as usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out, and you'll never miss our next analysis.
So our mission today is to really get the core thesis behind why some of the sharpest analysts out there are calling this company a sleeping giant.
A sleeping giant, okay.
Yeah. The whole narrative is about this critical convergence.
Yeah.
Taking the infrastructure they built for massive Bitcoin mining and redirecting its immense power capacity. And we're talking 1.7 gigawatts, squarely toward the endless hunger of the AI market.
Yeah.
And that transition, it really changes everything.
Okay, let's unpack this business. Before we talk about the AI future, we have to look at the present. So where is the revenue actually coming from right now?
Good question.
And is the existing business, healthy enough to even fund this huge pivot?
That is the right place to start. And the short answer is yes, the core business is robust. Right now, 92% of the revenue still comes from Bitcoin mining.
Okay, so still overwhelmingly mining.
For now. But the performance is stellar. In Q3 of 2025, Riot reported revenue of about $180.2 million. And crucially, that number beat the analyst consensus pretty comfortably.
And the increase in efficiency is really the story here. I mean, we're not just looking at top-line growth. We're seeing operational mastery. Riot essentially reversed a massive loss from the prior year, reporting Q3 net income of $104.5 million. That translates to 26 cents diluted earnings per share. But the number that really jumps out at me is the gross margin expansion.
Tell us about the margins, because that's the fuel for the whole AI engine.
Exactly. Their Bitcoin mining gross margins, they've expanded from 42% last year all the way up to 59% in Q3.
That's huge.
Think about that. They're getting almost 50% more value from every single dollar they spend on electricity compared to just a year ago. That's the kind of efficiency that gives them the capital to do this.
That margin expansion is absolutely key. But you mentioned caution. The market isn't pricing in perfection just yet. Forward expectations. They actually anticipate a slight dip for Q4 2025 revenue, around $165 million.
Okay.
And analysts are modeling an expected EPS loss of about negative 14 cents.
Wait, hold on. If the company's executing so well with 59% margins, why is the next quarter expected to show a loss?
That's where the analysis gets, a little nuanced. The critical detail here is that analysts fully expect upward revenue revisions. And those revisions are tied directly to these impending AI and HPC deals. The loss you're seeing is really just a short-term accounting thing. It reflects the massive capital they're spending right now to build out that new capacity. It's an investment period.
Not a failure in operations. Okay, that makes sense. Speaking of investment, let's talk about the war chest they need to pull this off. The balance sheet looks incredibly strong.
It is.
They had $330.7 million in unrestricted cash and $170 million in working capital at the end of Q3. They have some serious financial firepower here.
They absolutely do. And they're using it with a very clear strategy. I mean, their financing has been incredibly intentional and aggressive. They raised over $600 million in equity.
Which always makes people worry about dilution.
Always. But they're clearly prioritizing growth. And then you had that massive strategic sale back in December 2025.
The one that raised some eyebrows.
Exactly. They sold 1,818 Bitcoin. It brought in a staggering $161.6 million. And they did it at a great average price, too, near $89,000 per Bitcoin.
So that's my immediate question. If they're the most efficient miner in the space, why liquidate nearly 2,000 Bitcoin? Doesn't that kind of signal a lack of confidence in their original business?
It signals a shift in corporate priority, not a lack of confidence. The funds from that sale are being exclusively reinvested into the Corsicana AI data center expansion.
So it's all going into the new project.
All of it. The message to shareholders isn't that Bitcoin is weak. The message is we're trading short-term asset accumulation for long-term revenue diversification. Stability. They're choosing this massive, more predictable growth project over things like dividends or buybacks. It's short-term pain for long-term de-risking.
That focus brings us directly to their competitive advantage, their moat. If the strategy is moving to infrastructure, what makes Riot's infrastructure so different?
Their moat isn't just a building. It's a strategically located, enormous power advantage. The core asset is their 1.7 gigawatt gross power capacity.
1.7 gigawatts. Let's put that in context. That sounds like enough power for a small city.
It is. Think of it this way. In the world of high-performance computing, the super intensive computing needed for training AI models, power is everything. Cost and availability are the most critical factors. Riot basically owns the equivalent of the best commercial real estate location in a super high-demand market. They've secured and optimized that power structure in Texas, which is known for its flexible energy market.
So their advantage is essentially being able to provide guaranteed, affordable, high-density power that these AI customers are desperate for, right?
Precisely. This infrastructure is specifically optimized for these HPC workloads, which means they can host the thousands of GPUs required for advanced AI. And that optimization creates really high switching costs.
Right. Once a tech giant parks their AI stuff there, they're not moving.
They are not moving easily. And that's what allows them to diversify into this stable AI revenue, something their pure mining peers just can't do quickly. Analysts project that contracts just for the Corsicana data center alone could eventually bring in $1 billion a year.
$1 billion annually.
If that happens, it completely changes their whole revenue profile. It goes from volatile Bitcoin mining to predictable contracted services. That's the whole value proposition.
Here's where it gets really interesting. Let's pivot to the charts and see how the market is translating these massive fundamentals into actual price action.
Okay, so shares are currently trading around $17.20, and that's within a pretty wide 52-week range. But we have seen significant bullish movement recently, a rally of 27.5% year over year and nearly 30% in just the last month alone. That signals some really strong psychological momentum as the market starts to, digest this AI story.
However, we did see that recent sharp 13% weekly pullback. This is where the skeptic in me pops up. Was that a sign of trouble?
Well, analysts are looking at that pullback a little differently. They're actually calling it an accumulation phase.
The accumulation.
The thinking is that institutional investors who believe in the long-term AI thesis are using these little dips to build their positions. And what gives them confidence is the operational growth, like deploying a hash rate of 36.6 exahash per second. It just shows the sheer strength of their mining fleet.
So the market sees this operational muscle, that EHS figure, as a signal that the company has the capacity for a massive breakout once the AI pivot is really validated.
Absolutely. And if we look at momentum and flow, the trading volume is elevated, almost 20 million shares. But what's really telling is the options flow.
What's that look like?
We're seeing calls leading puts by a 3-to-1 ratio. That is a very clear signal of bullish anticipation. Investors are expecting a large, imminent price move.
And that anticipation isn't just retail frenzy, right? Piper Sandler, for instance, is citing a significant 55% upside potential, slapping a $26 price target on the stock. That kind of analysis reinforces this whole momentum narrative.
Right. And moving past the charts, we need to gauge the broader market perception. What is the consensus telling us about how institutions see this company?
Well, if we weigh the quantitative scoring, just based on recent news and technicals, the weighted sentiment score is around 0.32, which clearly puts Riot into the bullish category.
And that translates into a strong buy consensus across the analyst community. We're talking 12 to 18 analysts. Their average target sits somewhere between 25.81 and 26.58.
So that's implying, what, 50 to 56% upside from where it's trading now?
Exactly. That high conviction is why you see firms like Piper Sandler maintaining their overweight rating and specifically calling Riot that sleeping giant.
So what are the specific positive developments that are driving this, overwhelmingly bullish sentiment?
You can list a few. First, that Q3 revenue beat. It provided some necessary confidence. Second, the operational success continued with an 8% month-over-month increase in December's Bitcoin production.
Okay.
And third, and this is the most critical part, is the successful strategic funding of the AI data center pivot. Using the money from that big Bitcoin sale. The money is in the bank and the plan is in motion.
And we are seeing that confidence reflected in institutional flow. I saw a major fund added $4.5 million to its position in Q3, which shows conviction in the long-term infrastructure play, not just the crypto volatility.
Precisely. We can note the standard corporate stuff like the planned CFO transition set for March 1st, 2026, but the overall institutional flow is highly constructive.
Now let's talk about the giant lever that everyone is waiting to see pulled. The primary speculative rumor circulating right now is huge.
It is. The market is anticipating a concrete multi-year AI or HPC deal announcement, and they're anticipating it very soon. The expectation is that this could coincide with the Q4 earnings call, which is expected around February 23rd.
This is the moment of truth, then. That deal announcement is seen as the primary catalyst required to deliver that outperformance and really separate them from their pure mining peers. It validates the entire strategic shift.
We've covered the massive opportunity, but critical thinking means we have to thoroughly examine the bear case. What are the key risks that could derail this whole thing?
The first major risk is volatility and dilution. Let's start with volatility. The stock carries a high beta, currently at 3.67. For our listeners, that means if the overall stock market moves 1%, this stock has historically swung 3.67% in the same direction. When Bitcoin slides, this stock slides far more violently. We've seen 10 to 11% drops tied directly to Bitcoin price swings. That sounds like a heart attack stock for a conservative investor.
That is absolutely true. The high beta confirms that right now Riot is still trading like a volatility play. But the mitigation is the reason for the dilution and volatility.
Okay.
Yes, financing the 1 gigawatt campus with that $600 million equity raise risks short-term dilution.
Of course.
But the company sees the Bitcoin sales and the equity raises as necessary moves to fund the AI pivot, which fundamentally de-risks the company long-term. They are trading that short-term volatility for the long-term stability of contracted revenue.
That's a strong counterargument. Okay, let's move to the second major risk. Execution and valuation. The anticipated Q4 EPS loss signals caution, but the bigger red flag, especially for value investors, is the PE ratio. It's sitting around 41.65.
Yeah.
That is incredibly high. It suggests the stock is already priced for perfection.
It is priced for perfection, and that's the core risk. Can they execute the pivot? The valuation is high because the market is pricing in the future success of the AI infrastructure side, not just the current mining income.
Well,
If those AI deals don't materialize, the stock is clearly overvalued.
we also saw some notes about negative pre-tax margins in certain segments and a slight month-over-month dip in November's Bitcoin output. Are those small operational blips, or are they signs of bigger structural stress?
I think they're minor blips, especially when you balance them against the operational resilience. Remember that 59% net margin from Q3 we talked about? That shows the core business is operating very efficiently. Plus, despite the big sale, their overall Bitcoin holdings are up 70% year over year.
Right.
The main risk remains the execution. Can they secure those high-value AI contracts and build out that capacity on time? But given their scale and financial health, the probability of successful execution is, well, it's high.
So what does this all mean? After weighing the high growth potential and this imminent AI catalyst against the execution risks and the current high valuation, where do we ultimately land on Riot Platforms?
The conviction among analysts is just too strong to ignore the opportunity. We land on a bullish score, 8 out of 10.
That's a high conviction rating. So summarize the multi-year investment thesis for us, boiled down to the essentials.
The core thesis is this. Riot Platforms is currently undervalued at this price point, around $17. When you measure it against that $26 consensus price target, that offers about 55% potential upside. But this thesis isn't about Bitcoin anymore. It's built on leveraging its power-rich, scalable infrastructure for the desperate demand coming from the AI and HPC market.
And the mechanism to unlock that value.
The catalyst is that imminent expected AI HPC deal announcement. It'll probably happen around the February 23rd earnings call. If that deal gets signed, it fundamentally validates the entire strategic shift. So our target horizon here is a multi-year hold, betting on this massive convergence of crypto assets and AI demand.
That brings up a final provocative thought for you to consider as you digest this analysis. The 2024 Bitcoin halving is approaching, which will drastically cut mining rewards. So when you compare pure crypto miners versus infrastructure players like Riot, which model, the pure play or the infrastructure diversification play, will be best protected from the economic shockwave of the halving? Something to mull over.
Thank you for joining us for this deep dive into the massive transformation underway at Riot Platforms.
And if you found this analysis valuable, please make sure you subscribe, like, and comment to support the show. We'll see you next time.